following video is on venture capital. In this video, we'll examine what is a venture capital fund, its structure, and how it operates. To begin, we want to find out exactly what is a venture capital fund. A working definition is a venture capital fund is an investment fund typically organized as a limited partnership in which the limited partners provide the capital to an investment pool that is managed by the general partner. Although most venture capital funds are organized as limited partnerships, there are corporate venture capital funds and LLCs, which is important to note. Next, we want to look at the partners. Who are the limited partners? Endowments, pension funds, institutional investors, accredited high net worth individuals, and other sophisticated investors, including family offices, often make up the bulk of a fund's limited partners. These limited partners will contribute capital to an investment fund and agree to pay the management fee and performance fees to the general partner in return for any profits realized by the investment in the venture capital fund. Next, who is the general partner? The general partner in a venture capital fund is often a team of professional venture capitalists with deep background in the area of which they are investing in. The general partner relies on a strong team of analysts and deal makers to evaluate and execute on investments in startups and small businesses with high growth potentials. The general partner will most commonly be compensated in the form of a 20% performance fee and a 2% management fee. In this structure, the limited partners agree that the general partner takes a 20% cut of the performance of the fund, sometimes with a high water mark that must be reached first, and the general partner takes a 2% fee on assets under management to pay for operating expenses. Often the general partner will commit capital to the fund to ensure an alignment of interests and to show that the venture capitalist has quote-unquote skin in the game. Next, we want to look at the characteristics of a limited partnership venture capital fund. Characteristics of a venture capital fund include long-term private equity investment, 7 to 10 years, low liquidity, high risk, high possible return, low diversification. Now we're going to look a little closer at each of these factors. A venture capital investment constitutes a long-term private equity investment. This is because many venture capital funds require 7 to 10 years in order to realize the returns on their investments in companies. Much of these investments involve shepherding a small or startup company and moving them up the process, possibly to an IPO, which could be a multi-year process. Thus, private equity investors will need to commit capital for a long term. Additionally, there is low liquidity, meaning that you cannot trade your interest in the venture capital fund with other investors very easily except through secondary markets. There is the high risk, high return scenario in which much of the venture capital investments do not pan out in the way that you would hope, although for all of those that do not pan out, there are a few that do in the likeness of Facebook or Twitter or Google or any of those companies that have created significant value for their investors from the point of which they began the investment at the early stages. Finally, there's low diversification. This is because a lot of venture capital investments are in companies in the technology, telecommunications, biotechnology, software, those type of companies. That gives investors low diversification, but oftentimes they're willing to accept that with the possibility of a very strong upside. Next, we want to look at the process of a venture capital fund. And while it's a lot more complicated and there's a lot more legal framework to go with this will give you a rough overview of how the venture capital fund process works. First, limited partners sign a partnership agreement to commit a certain amount of capital to the fund. The general partner closes the fund after reaching an acceptable capital commitment level. So this will be the capital raising stage in which they're looking to investors. They're reaching out to endowments, pension funds, family offices, and they're looking to raise capital from them. And once they've reached a certain point, they cut it off to new investors. The limited partners do not actually contribute money until the general partner calls down the capital. When the general partner finds a company to invest in, the general partner will call down capital from the limited partners and invest it in the startup. The general partner can continue with capital calls up to the amount that the limited partner is committed to the fund. Any point beyond that, they would need to sign a new agreement or extend the capital. The venture capital fund will invest in a number of promising companies, and the general partner will often offer resources, advice, and business to help grow the business and improve management. As the business grows, the venture capitalist might look to an exit through an IPO, as was the case recently with Facebook, or recapitalization, where the venture capitalist exchanges its equity for cash. The management team gains equity incentives, and the company is positioned for future growth, or through a merger or acquisition with another firm. This concludes this video on venture capital. In conclusion, venture capital funds rely on limited partners to provide the capital to finance investments in a portfolio of small businesses and startups with high growth potential, as identified by the general partner team. The venture capital fund seeks to achieve high returns and in turn accepts high risk of failure.